While I'm sure much of my audience is familiar with the concept of Texas Roadhouse, what you may not know is that it's a publicly traded company you can invest in right now. So today I want to ask the question if you should, or if this Texas-inspired restaurant chain is just death warmed over. To start to answer this question requires a trip back in time. The year is 1993, not in Texas, but in Indiana. Kent Taylor had just opened the first Texas Roadhouse. This was not his first attempt at running his own restaurant, however. He had managed many a local food service chain and even had a crack at his own restaurant 2 years prior. Fortunately for Taylor, the Redneck Outback turned out to be a big hit. After raising a few $1 million in funding, Texas Roadhouse began its march across the country. By the end of the 90s, there were 67 restaurants across the US. The expansion would only heat up going into the new century, and by 2003, Texas Roadhouse was in more than 30 states and opening on average 25 new restaurants a year. The logical next step for Texas Roadhouse would be to go public to raise more money to fuel further expansion, and in 2004, TXRH would IPO, netting the company more than $160 million. Of that, nearly $100 million would go directly to Kent Taylor, and instead of riding off into the sunset with his newfound fortune, he used much of it to pay down the large debts his company had started to accumulate. Up until 2011, Texas Roadhouse would remain exclusively in the US. That was until its first international restaurant opened, somewhat oddly, in the UAE. After expanding throughout the Middle East, restaurants would start to be opened in places like China, Mexico, and Taiwan. Also in 2011, Texas Roadhouse would crack the $1 billion mark in terms of annual revenue. The primary driver of this continuous expansion, I think, is the brand that Texas Roadhouse has built. The company is very careful about how its restaurants are presented and take numerous extra steps to ensure the quality of each experience. If you really take a step back and think about it, it's almost obvious. Everything is carefully calculated. From the in-house butcher to the dinner-centric menu, it extends all the way down to having locally influenced menu items that are unique to every location. The precision with which the company operates is impressive, crafted to be an instantly recognizable brand known for its quality. Arguably, this is what makes the Texas-themed chain such an interesting company. But of course, this isn't the only thing that makes Texas Roadhouse a potential portfolio anchor. But before we get into that though, let's take a deeper dive into Texas Roadhouse's financials to better understand the company. Revenue growth is naturally very strong. Despite a small slowdown in 2020, the total hit an all-time high in 2021. In terms of shares outstanding, there's nothing special here. A very slight reduction over the last few years. It seems like Texas Roadhouse has just found the share buyback button and is seeing how it goes. Free cash flow is another area of outperformance and is mostly in line with revenue growth, which is good to see. Our first very interesting part of the financials comes when we look at return on invested capital. Last year, it was an astounding 13.9%, and over the last 5 years, the chain has managed to average 9.5% ROIC. This is notably higher than many of the other large restaurant conglomerates and further proves the power of the Texas Roadhouse brand. In terms of debt, there really isn't much. Total debt is $1.4 billion. The majority of that debt is on buildings, which is pretty good. Total assets amount to $2.4 billion with a few $100 million in cash on the books. Despite its rapid growth, Texas Roadhouse has managed to keep debt to a minimum. Now we come to our favorite part of the financials, the dividend. With a 2.1% yield, a sub 50% payout ratio, and an impressive 17% plus growth rate over the last 5 years, the restaurant looks like a very solid dividend growth pick. It should be noted though that the company was forced to suspend the dividend for 2 quarters in the middle of 2020. Other than that, Texas Roadhouse boasts a decently impressive, well-rounded balance sheet. No major problems obvious on the money side and plenty of things to like, especially that return on invested capital and dividend growth rate. So let's examine exactly how Texas Roadhouse plans to continue this meteoric rise to the top of the restaurant world. As we talked about earlier, Texas Roadhouse has this incredible ability to maintain a brand, and while the core restaurant business is growing nicely, I think a lot of the future growth will come from other channels. The company also owns Bubba's 33 and Jaeger's. Bubba's 33 is the big investment here, as Texas Roadhouse plans to open 25 more of them this year. Plus, the concept seems to be working. Bubba's manages to not only grow the total revenue it brings in, but also, and more importantly, grow the amount of revenue each location hauls in. This is called same-store sales growth, and it's slightly over 8%, which is better than the main brand. Jaeger's, the other restaurant concept, only has 4 restaurants in operation. The fast casual concept was only just finalized in the last quarter of 2021, so the jury is still out on this one. Both Bubba's 33 and Jaeger's will operate with similar menus as the main restaurant chain, so I expect Jaeger's to enjoy the same level of success, if not more, given its drive-through quick eats nature. Now, this is not to say that the core business is slowing down. In fact, it's the exact opposite. Texas Roadhouse saw same-store sales growth of 7%. While considerably lower than its smaller subsidiaries, the growth is still impressive given the size of the total operation. Another thing I want to touch on is the way Texas Roadhouse managed to handle 2020. While its physical locations were basically shut down by force, the company made a hard pivot to takeout. As a result, it only managed to experience a minor slowdown in total revenue. Now, nearly 2 years removed from the brunt of the restaurant shutdowns, to-go is still in place and still brings in more and more money despite being a lower percentage of overall sales. To-go is now a permanent option and a more important part of Texas Roadhouse's overall business. Why? Because while it might seem small, many other restaurant chains suffered far more, and some even shuttered their doors permanently as a result of 2020. Many lost the majority of their revenue, were closed longer, and are still struggling to bounce back. Roadhouse's resilience also tracks back in time, going back to the great financial crisis of 2008. While same-store sales growth was negative, it was only slightly so. Overall revenue increased due to the positive financial position the company was in at the time too. It used the uncertain times to open more restaurants and further build out the business. While I do hesitate to deem the company recession-proof, I am willing to say there's reason to believe that it can remain resilient in the face of hard times. And the hard times have certainly come back. Texas Roadhouse has been hit particularly hard by inflation. From commodity prices soaring to wage pressures, overall costs are rising. For instance, steak makes up approximately 50% of the company's total revenue, but the price per pound of beef alone has risen 11% or so since the beginning of this year. This, along with other commodity price pressures, has taken a toll on Texas Roadhouse's overall margin. Instead of passing along all of the costs to the end customer, the company has decided to take the temporary pricing pain to preserve customer loyalty. This approach is seemingly working when you consider the aforementioned steady growth. And if you want to help the steady growth of this channel, be sure to sub and like below. However, these inflationary pressures could prove to be longer lasting than previously anticipated. KKR reports in its most recent mid-year update that it expects a period similar to the 1970s with relatively low economic growth and higher than normal inflation. While Texas Roadhouse has certainly been through a recession, it has yet to deal with many economic conditions of the past. It could severely hurt the brand. While I don't believe that higher than normal inflation will be the ruin of the company, it could hurt for a long time. Combine this with the marching higher of beef prices, and it might just be enough to force Texas Roadhouse into defense mode, requiring further tightening of its balance sheet. All of this leads me to believe that the buying back of franchise locations is actually a bad move, at least in the short term. In the past quarter, 6 franchise locations were bought out and made corporate stores. Instead of bringing these locations into the fold, it might just be better to stockpile cash to further stave off the potential of higher inflation. Sure, franchise locations aren't growing as quickly, but this is a small price to pay for that extra resiliency. With that said, I think it's a good idea to re-examine the same-store sales growth that was oh so impressive in quarter 2. The 7.6% growth was pushed by customers spending more on average per visit. Sure, it's not enough to keep up with inflation, but still enough. Hidden away, however, is the fact that the total guest traffic fell nearly 1% year over year. In other words, there's a drawdown in traffic to Texas Roadhouse. While management seems adamant that this is purely cyclical and traffic will resume, this little fact is something to closely monitor over the next few earnings calls. I don't believe Texas Roadhouse itself is in secular decline though. I do lean towards the idea that given recent economic conditions, overall traffic will continue to decrease in the short term. People might not be able to afford spending a few extra meals at any restaurants, let alone Texas Roadhouse. Plus, another thing I want to quickly mention is the recent change of management. After last year's tragic loss of founder and CEO Kent Taylor, Gerald Morgan was selected to lead the company in Taylor's stead. While the obvious choice has been Morgan since he's loyally been with the company since 1997, he still has yet to actually prove himself a good successor. It reminds me of when Jeff Bezos stepped down as CEO of Amazon and Andy Jassy took over the reins. Yes, Bezos is still around to help Jassy, making this transition easier, but Morgan doesn't have that. He has to maintain and move the Texas Rugged brand forward without Taylor's help. And it's not like the board of directors will be of much help either, considering they're just as inexperienced, with the average tenure at Texas Roadhouse being a measly 2 years. Really, I think there's a lot to consider with Texas Roadhouse, such as a short-term economic bite stealing profits, and the inexperience of management. All of this, though, is counteracted by a stellar brand that's building out sub-brands, further entrenching Texas Roadhouse. So that leads us to the question, will I be investing in Texas Roadhouse? And the answer is yes. I do plan on opening a position in the restaurant chain. Probably not for a while, though. I want to continue to see how this inflation story plays out. Along with this, I want to see how management continues to operate both Bubba's 33 and the opening of Jaeger's. While I continue to be optimistic about the company on the whole, my valuation scales are not. I get a fair value in the ballpark of $45 to $50 a share. While we are quite far away from that, I believe if the general economic weakness persists, the share price could get that low. With that, I hope you enjoyed and maybe learned something. I would love to hear your thoughts on Texas Roadhouse in the comments below. And if you enjoyed this video, I'll bet you enjoy the video popping up on screen now. And as always, this is Dollars and Cents.